Hi guys, welcome to my YouTube channel. This is King EJ World. I'm super excited to bring you yet again another amazing video. Now in today's video, I have a whole lot to talk to you about. We're going to be talking about liquidity, guys. Liquidity. Now if you're a forex trader, a crypto trader, or you trade the markets, you want to know what is liquidity, how to understand and how to take advantage of liquidity while you're trading. I'm going to be going to the charts, showing you a couple of things that is going to scale up your forex game, your trading game to the next level. I'm also going to be introducing my new strategy that has been doing amazing numbers. Look at this, amazing numbers. And you want to learn about that. Remember, the King EJ World Mentorship is a special mentorship course where I train people on how to scale up their finances to the next level. Now, it's not just a forex mentorship course. It is a course where I teach people about life. I teach people about how to make money. I teach people how to scale up their finances and how to be better versions of themselves. It's a train me, I train you course. I like to say, train me, I train you. So what do I mean by train me, I train you? It's simple. We work together. Iron sharpen iron. Sticks don't sharpen iron. Iron sharpen iron. That simply means if you're good, I'm good, and we work together, we'll be better. So you want to be a part of the King EJ World Mentorship, hit the link down below and join the community. Let's get started, let's get connected and scale up to the next level. This is 2025, your year and my year. So let's get started. See you at the end of this video where I'm going to introduce something different. Subscribe, hit the like button, hit the share button, hit the notification bell so that you can always get the latest videos from King EJ World. So let's get started. Stay tuned. Hi guys, welcome back to the channel. We're talking about liquidity today, and we're looking at how does liquidity work. Now, first of all, what is liquidity? Now, liquidity is a simple terminology where we look at where I like to explain it as looking for where the money is. Looking for where the money is. Now, what does that mean? So, for example, let's say you buy at this level, right? And price goes to a certain direction, right? Let's say you buy at this level, and price heads to a certain direction. Now, normally, as a retail traders will buy at this level and put their stop losses below the structure, right? That's what a retail trader would do, right? Now, that is what a retail trader would do. And let's say probably we'll expect price to return back to that direction to solidify the position to enter another position. Now, usually when you say liquidity, you are looking at the point where retail traders will put their stop losses and take profits. So basically, that simply means when you talk about liquidity, you are looking at other people's money, looking for where the rest of the market has money stocked in. So, for example, for this market now, I already know clearly that people have money stocked here. So, all these places are points of liquidity. So, for example, just like here, if this hadn't played out, this was a point of liquidity. All these places were points of liquidity. And guess what happened? When price came in, it came back to test liquidity here. And guess what? It came tested liquidity. Now, sometimes price has been in an overall uptrend, so it tested the liquidity, it absorbed it and continued in the direction of the liquidity, same here, there's liquidity here. Price continued upwards, came, absorbed all the liquidity here and continued in direction, in its correct direction. Now, liquidity is simply other people's stop losses and other people's take profits, taking advantage of other people's stop losses and other people's take profits. Now, there are different types of liquidity, right? We have support and resistance liquidity. Now, look at this. This is a support and this is a resistance. So price comes in, comes back, comes in, goes in this direction, right? And it comes, absorbs this liquidity. Now, because price was already in an upward trend, which is the correct direction, so this was corrective, it continues in a direction. So you see, it comes, absorbs, takes out everybody's stop loss. For example, now retail traders would have had their trades like this. somewhere like this, right? It comes, takes out their stop losses, gathers momentum with their liquidity and goes in the correct direction. So support and resistance liquidity is just looks out for support regions or resistance regions, and the structures, the stop losses above such regions form points of liquidity. Okay, now bear that in mind. Now, the next type of liquidity we are looking out for is trend line liquidity. So, for example, in this situation, price is on a trend, right? And touches this trend, goes up, touches. Now, normally, traders would have put uh a take profit like this, a price like a position like this, right? Now, see what happens. Price comes, touches the trend, takes out the trend, comes to the place of liquidity, takes out that place of liquidity, takes out and continues in a direction downwards. Now, the thing you need to understand with liquidity, sometimes price would have come here and return back into the trend, or come here and continue in its correct direction. So a point of liquidity is a point where retail traders are expected to put their stop losses or put their take profits. You have to consider what price reactions will happen in such places. So, for example, in this kind of place, we already know that price came, took out liquidity, came in here, and came in here. See, it's very easy now to have the idea that I'm supposed to sell. Now, I'm going to also explain the strategy by the end of this video. Just get the various concepts in your head. So, the second type of liquidity is trendline liquidity. The next thing, the next one is what we call fail to close liquidity. Fail to close liquidity is a simple type of liquidity situation where you have almost like a trend, like a range. So price comes. So price has been testing this range for some time. It's been testing this range. See, test. Obviously, liquidity is above the structure. And guess what happens? It comes, it takes out the liquidity, and voila, it goes in the right direction, comes back later on, but it has already taken out the liquidity and gone in the direction that it's supposed to go, right? Now, the next one that is fail to break liquidity. I'll show you fail to break liquidity. Now, fail to break liquidity is a situation where you have liquidity that price comes into a particular direction, comes down, tests that order block. Now, what's an order block? I'm going to explain what an order block is. Order block is the bullish candle that occurs before a major bearish move, or the bearish candle that occurs before a major bullish move. So, for example, this is the bullish candle that occurs before a major bearish move, right? This is the order block. So, for example, this is also an order block. This is the bullish candle that occurs before a major bullish bearish move. So, for example, here, this is the order block here, the bearish candle that occurs before a major bullish move. That's what an order block is. Now, in this situation now, price comes into this place, comes back, forms almost like a double top, doesn't conveniently go into the order block. Now, the order block, the points of reaction when you're looking at the order block are, first of all, you talk about the high, you talk about the open. Now, the high price and the for a bullish order block like this, that's the high price and the close price. Once it invalidates that, it means that order block has been invalidated. So what you look out for is the low price and the open price. So this comes, touches the low price and continues in the direction. Now, this is why I tell people that when market comes into a region the first time, the second time, if it's coming back the third time, it will invalidate it. So, for example, now the buyers in this place, right, take price up. It comes back here, the buyers in this place takes price up, but the sellers here are more than the buyers here and the buyers here. It comes and it takes it out. Now, if price wants to return back to this place, it's going to take it. It's going to take it out to cover up all these points of liquidity, because this is where you have your stop losses of people who sold. Just like this situation, just like we had here, when it first came here, when price first came here, you see, it returned, but this was where you had your stop losses. And guess what happened? This is where we had our stop losses. This is where we had our stop losses, right? And when price returned back to this place, it took out the stop losses completely. Took out the stop losses. Now, two things would have happened. Either it went in the correct direction, or it tested an order block below and continued, which is what happened. Tested and continued downwards, completely absorbing the liquidity. So liquidity looks at the stop losses and the take profits of other people. Now, that being said, let's talk about something else. So we've talked about types of liquidity, we've talked about support and resistance liquidity, trendline liquidity, fail to break liquidity. We've talked about order block. I'm going to talk about what is a trap, what is an inducement very quickly, and we're going to combine all of these things together. Now, what is a trap? A trap is a situation. We already have one here. This is an example of a trap. So let's say we put a sell here. Let's say we had put a sell here or a buy here, right? Let's say we put a buy here, thinking that, okay, because price will come and sweep out liquidity. They call it liquidity sweep out liquidity and go in the direction that we were thinking, right? See what happens. Price came, swept out liquidity, took out people's stop losses, acted as though it was going to go in my direction and took me out. So this is what is called a trap. So let me make this bigger. What happened here was price came, took out liquidity, right? Took out liquidity initially, acting as though it was going to go back into my direction, but took me out. This is what we call a trap. This is what we call a trap. Okay? That's what we call a trap. I hope you're following that. Now, we've explained what an order block is. We've explained what a trap is. Now let's look at what is an inducement. An inducement, in the other hand, I'll use this to show you what an inducement. An inducement is a situation where you have price going in a certain direction, comes back, going in a certain direction, comes back before it comes to the point of interest. So, for example, this is our point of interest, knowing that, okay, if price touches here, it's going to go back up. I took this trade some days back. So it's BTC. So let's make it big. So price went in a certain direction, returned back to that direction, acting as though it was going to come to this place. So this is like a manipulation, acting as though, okay, coming, I'm coming, to give you a fake idea to sell or to buy. But it goes again and comes back. This is a double inducement. Still giving you that idea that, guy, buy now. But it doesn't come to your point of interest. It now goes up. This is what we call an inducement. It now goes up and now returns back to where it is supposed to actually take action, which is the order block. If you come to the 30 minutes time frame, this was the order block. The order block of reaction was this. And voila, it went in the direction. And I took it in the double top. In the double, because after it spiked up, I didn't see it. When it came down, I took it from here and it went all the way. Went all the way. Do you understand? So this is what is called an inducement. A point in the market that is kind of, you know, giving you like an appetizer or trying to deceive you that, okay, sell at this direction, but it's not the correct point. It is supposed to be at your POI, but it's acting as though it's coming to your POI, but it's not getting to your POI, which is your point of interest. I hope you follow that. Now that's what is called an inducement. Now, how do you know an inducement? An inducement must be 50% below point of reactions. Must be 50% below point of reactions, or at 50%, at least 50%. Now see this, if I draw a fib at this level, notice it's 50%. It cannot be less than 50%. If it's less than 50%, for example, yeah, we have an overextension a little bit above 50%. So you can say maybe at 30 something percent, but it cannot be close to 0%. It cannot be close to, like, say 10%. No, it has to be around 50%. Around 50%. It cannot be less than 30%. Let me show you something. It cannot be less than 38. See, it closed above 38%. So if it was far at 20, 25%, that's not an inducement. It's too close to your point of interest to be an inducement. I don't know if you follow what I just said now. So an inducement must be around 50% for us to be able to know that it's an actual inducement. And then we now talk about the point of interest, which you are taking your trade based on your order block or your fair value gap. I'll talk about the fair value gap in my next video. Now, just to make this video not too long, what I'm going to do is that I'm going to break this video into a second part. So we're going to stop here. I want you to subscribe to the channel because the next video I'm going to be teaching you my strategy on how to take advantage of all of this information I have given to you. So subscribe to the channel, hit the notification bell so that you don't miss out on the various things we're talking about. See ya.